All right, today we're going to dive into a simple, almost radical way to build some serious wealth. It's called coffee can investing. And honestly, it might just be the most powerful secret that's hiding in plain sight.
You know what I'm talking about, right? Open any financial app, any website, and bam, you're just hit with this wall of noise. Personal loans, credit cards, mutual funds, endless trading tools. The entire system, it's designed to make you do something. Click, trade, buy, sell, now. It's this constant, overwhelming call to action.
I know, it sounds totally backwards, doesn't it? We live in a world that rewards action, speed, being busy. So, what if the most profitable move you could make is to just sit still? Let's really dig into this idea because it basically challenges everything we're ever told about investing. So, why is it so important to tune out all that noise? Well, because the market is just full of risk. Take a look at this data on startups in India. Over 11,000 have already shut down in 2025. That's a 30% jump from all of last year. This is what happens when people chase the next hot thing. It's the complete opposite of the stability we're talking about today. It's a really dangerous game. So, how do we actually cut through all that chatter? Well, first, we've got to understand the illusion of quick wealth that the market is constantly selling us. And then we're going to find a method that just flips that entire script on its head. You know, the whole idea for coffee can investing kind of started by accident. It's a great story. Back in 1984, there was this portfolio manager, Robert Kirby, and he was just reviewing his clients' accounts. And he noticed something kind of wild. One of his absolute best performing accounts belonged to a client's husband. And what had this guy done? For years, he had just been copying Kirby's buy recommendations, but he totally ignored all the sell advice. He just bought and held on for dear life. And that right there, that's the heart of coffee can investing. The name comes from this old practice in the American West where people would put their valuables in a coffee can and just bury it for safekeeping. For investing, it means you buy a portfolio of really high-quality stocks and then you do nothing. You literally fill the can, shut it, and forget about it for at least 10 years. Okay, now this is the crucial part. This doesn't work with just any old stock. You can't just buy random companies and hope for the best. There's a really strict, disciplined way to find the right companies. So how do you find these gems? Well, it all comes down to two golden rules. It all boils down to two things that are absolutely non-negotiable. First, consistent growth. The company's revenue has to have grown by at least 10% year after year for 10 straight years. No exceptions. This weeds out all the unstable businesses. Second, high efficiency. Its return on capital employed, or ROCE, has to be over 15%. Again, for every single one of those 10 years. So what on earth is ROCE? Just think of it like a report card for the company's bosses. It answers a really simple question. For every single dollar the company puts into the business, how many cents of profit does it spit out? A consistently high ROCE, like over 15%, tells you that this company is a well-oiled machine. It's just incredibly good at turning capital into profit. So here's how you actually do it, in 5 steps. 1. You start with companies that have been around for at least a decade. 2 and 3. You apply those two super strict filters for growth and efficiency. That's going to leave you with a very, very short list of elite companies. But then comes step 4, and this is the human part. You do a governance check. You got to do some digging, look for any red flags, and make sure the management is clean. And finally, step 5. You don't put all your eggs in one basket. You build a diversified portfolio of 10 to 15 of these gems. Okay, and now for the fun part, the payoff. Why go through all this trouble just to sit on your hands and do nothing? Well, this next part shows you the almost unbelievable power of just holding on and the pure magic of compounding. I mean, nobody says it better than the man himself, Warren Buffett. This isn't about day trading or timing the market. It's about becoming a part owner in a fantastic business and just staying there for the long haul.
And if you want to see this in action, I mean really see it, look no further than the legendary story of Wipro in India. Imagine you bought just 100 shares way back in 1980. Over the next 40 years, through stock splits and bonus shares, those original 100 shares just kept multiplying again and again and again. The value didn't just go up, it compounded exponentially. So what was the result? Those 100 shares, which would have cost just a few thousand rupees back then, would today be worth, are you ready for this? Approximately 395 crore rupees. No, that is not a typo. That is the absolutely mind-bending power of finding a great company and just having the patience to do nothing. And on top of that, there's another huge practical advantage: taxes.
In India, if you hold a stock for more than a year, you pay a lower tax rate on your gains, 12.5%. But a frequent trader, they're paying a much higher 20% tax on their gains, and they're paying it over and over, which just constantly eats away at their returns. The coffee can investor puts off paying taxes for years, letting their entire pre-tax amount grow and grow. Okay, so you might be thinking, if this method is so simple and the results are so powerful, why isn't everybody doing this? That is a great question. And the real challenge, as we're about to see, has nothing to do with finance and everything to do with psychology.
That's it. That's the secret. The single biggest enemy you'll face is just plain boredom. It's that temptation to act when your friend is telling you about some stock that just doubled in a month while your portfolio is just kind of chugging along. The discipline to resist that excitement, that is the hardest part of this entire strategy. So let's just lay it all out. The advantages are huge, right? It takes almost none of your time, your costs are super low, and it saves you from your own worst enemy, like panic selling when the market dips. But what about the limitations? Well, you absolutely need a 10-year timeline. Some of these great stocks can be pretty pricey to get into. And like we just said, it can be incredibly boring. And that really brings us to the final, most important question you have to ask yourself. Are you in the market for the thrill of the trade, for the excitement of watching the numbers go up and down every day? Or are you investing to quietly and methodically build long-term wealth? Because the answer to that question will tell you everything you need to know about whether this boring but incredibly powerful strategy is right for you.